This video is about option trading for the beginners. Considering that, I will keep the video very simple and I will take you step by step. I am an option trader. As we go along the journey, I will introduce to the new concepts as well as the advanced level option strategy. In this particular video, we will see what is call option. Rather than going for a definition of the call option, what I will do is that I will take you to the real-time examples. If you understand the real-time example, understanding of the call option will become very easy. So once we understand the real-time example, then we will go to the particular stock and we'll see how the call option works. To understand the call option, let's take an example of the real estate. Real estate agency, they are constructing a plot of 30-40. Okay, so this construction requires 1 year of time. Okay, anyone interested to buy this plot, right? What they have to do is that they have to pay an 1 lakh in agreement. Okay, so their condition is that the site value is around 10 lakhs, and if you want to buy that, you have to pay 1 lakh and make an agreement with them. The remaining 9 lakhs is there, right? You have to pay at the time of registration. Now you want to buy the site. So your assumption is there, right? The area around they are constructing the site, right? Due to the infrastructure development or the colleges or anything, okay, the site value might increase from 10 lakhs to 20 lakhs or 30 lakhs after 1 year. So what you will do is that you will get into the agreement by paying a 1 lakh to them. Okay, once we get into the agreement, there are 3 possible scenarios. The first one is that land price increases from 10 lakhs to 20 lakhs. At the time, what you will do, you will pay the remaining 9 lakhs and you can own the property, or else you can sell the land to the 20 lakh, make a profit of 10 lakhs. Second scenario, the price of the land decreases from that 10 lakh to 5 lakh. Whatever the reason may be, the water shortage or the infrastructure is not good, whatever the reason, the land price decreases from 10 lakhs to 5 lakhs. In that case, what you will do is that you won't buy the land. As a owner of the call option, right, you do have a right, okay, whether you want to own it or not. In this process, what will happen that we will lose 1 lakh which paid in the agreement. Okay, but we are not going to buy this. Why we are not going to buy this? Currently the price of the land is 5 lakhs after 1 year. Okay, why you want to pay again 9 lakhs? If you want to own, you can directly own by paying a 5 lakhs, right? So that time you won't own the land. Okay, that means the buyer of the call option has a right whether you want to own or not. Okay, and the third scenario, the land of the price after 1 year remains the same. That is initially estimated around 10 lakhs. Now it is valued around 10 lakhs. So in that process, we won't gain anything, neither we lose. This is exactly how the call option works. We understood the call option using a real estate example. The most important point over here is that buyer of the call option, right, they don't have an obligation to buy the stock. In our second scenario, the price of the land decreases from 10 lakhs to 5 lakhs. At that point of time, what the owner of the agreement did, they didn't buy the land. So similarly, the buyer of the call option has a right whether they want to own the stocks or not. Now we'll go to a particular stock and we will buy a call option and we will see how it works. In this example, we buy a call option on Reliance stock. So when we buy a call option, when our assumption is that market might go up. Similarly, in the real estate example, so we made an agreement paying a 1 lakh, right, with the assumption of the land price might go up. Similarly, if your assumption in any particular stocks might go up, that time you can buy the call option. In this example, what we are doing is that we are buying a call option of Reliance. Okay, Reliance is currently trading around 2,960. So what I am doing is that I am buying a call option of strike 3,000. What it means is that when I buy a call of 3,000 strike means if the market goes above 3,000, okay, let's say 3,200, okay, by end of the June, so I will make a profit. So let's see how the payoff diagram looks. Okay, here we can see we paid a 9,800 to buy this call option. In our real estate example, what we did is that we paid a 1 lakh for the agreement. Likewise, in call option, we have to pay some premium. And the second important point is that here you can see the expiry will happen around 27 June. What it means, like for our agreement, right, after 1 year it will expire. So likewise, when we buy a call option, right, it has a time frame. Here you can see is 27 June. So this is valid only till 27th June. If the market moves up, okay, we will make a profit. So how much profit we make, it directly proportional to the how much the stocks moves. Let's say 27th June, the Reliance is trading around 3159, 3159. Then what is the profit we will get? The green box which you can see, right? 29,888. That is the profit we will get if the Reliance is trading around 2159 27th June. Okay, it's the profit is directly proportional to the movement of the stock. Another scenario, the market doesn't move up. Okay, this particular stocks, right, it doesn't move up, in fact it goes down or stays here. So what might happen? We will lose the premium. Okay, here you can see 9,862 which we paid, right? That is what we're gonna lose. What it means, the maximum loss is that whatever the premium we paid to buy the call option, right, that is our maximum loss. What is our maximum profit? Maximum profit directly proportional to the market movement. That means the profit can be unlimited, the loss is limited. And the third scenario, so let's say third scenario, the market expires around over here. Here you can see there is something called as a break even. So break even is 30,040. Okay, so if the market expires around 30,040, so what it means, the expiry means 27th June is there, right? That particular day market closes around 30,040. If that is the case, we won't make any profit, neither we lose any money. So whatever premium we paid, right, that is what we will get back. Okay, so there are three scenarios. If the market goes up as we expected, then we will make a profit. If the market stays here or market goes down, then we will incur a loss. The loss is the maximum amount we pay to buy the call option. The third scenario, so if it expires around the break even point, we neither make a profit nor we lose a money. So whatever the premium we paid, right, 9,800 something, that is what we will get back. So it is similar to the in real estate, right, third case scenario. So we pay 10 lakhs, the site valued around 10 lakhs, okay, at the end of the 1 year. You guys might be wondering what is this break even, how it is calculated. In this example, right, we bought a call option of 3000 strike call option we bought. What is the premium we paid? Here you can see is 40. Okay, so add these two things, so we will get the break even point. Okay, 30-40 is our break even point. So above which we will make a profit, below which we will make a loss. One more thing, how to calculate how much profit we will make. For example, we already know how to calculate the break even, right? 30-40. So imagine June 27th. Okay, so the market expire around 3,200. So our break even point is what? 30-40. So what is the difference between these two? 160 points. Okay, 160 into the lot size of the Reliance. What is the lot size of the Reliance? Is 250. If you do this, then you will get the total profit which we will get at the end of the month. Let us summarize the things what we learned so far. We buy call option when our assumption about a particular stocks, it will go up. Call option has a limited loss. What it means is that whatever the premium we paid to buy the call option, right, that is the maximum loss we can get. Call option has a potential for unlimited profit. And the fourth one is that call option buyers don't have an obligation. So basically it's not necessary that you have to own it if market goes against you. I hope you guys enjoyed watching this video. Thanks for watching.